Welcome into the reaction channel, folks, and cheers. Congratulations to everybody out there making some good money, a bunch more money to be made out there here today. I got a bunch to react to in this one here today. So first off, looking to react to the newest payroll numbers here, and we'll talk about that and kind of what it means for the economy. Additionally, Dan Niles went on CNBC a couple hours ago, spoke about where he sees the market going. I want to share my opinions and perspectives on that one. We have JP Morgan Asset Management's chief global strategist talking about where he sees the economy headed and the markets. Stacey Rascon, who's seen as a semiconductor expert, talks about we're seeing signs of a cyclical bottom in semiconductors. So looking forward to reacting to that, share my opinions and perspectives on kind of, let's talk about, AMD stock, NVIDIA, Broadcom, a lot of the other semiconductor names, okay? Marko Kolanovic delivers market pullback warning. Marko Kolanovic has been highly respected over the years, up until really the last few years here, but basically they even called him Gandalf. They called him, a part god of the stock market in terms of his ability to time out the market and know what's going on. So anytime he goes on, this is the first TV interview he's done since leaving JP Morgan. And there's a lot of debate whether he got fired from JP Morgan or whether he voluntarily left or was forced out. So I'll look forward to reacting to his opinions here and kind of sharing my opinions and perspectives on all that, and then we'll finish off talking a little bit about stocks, Tesla, those sorts of things, and kind of where some things are headed there. Appreciate everybody joining me as always. Thanks so much for being here, folks. Only one thing all I need from you: smash that like button. That's all I need from you. Please hit the like button. That's all, man. If you want to subscribe to the channel, you can certainly subscribe. I think we're getting close to 96,000 subscribers here on the channel now at this point in time. Additionally, I've been sending a ton of six-figure, seven-figure awards out to the private stock group members. Private stock group members, get your photos in for the Hall of Fame. A lot of you guys have been slacking with getting your photos in for the Hall of Fame. So send them on in. Send them to me, send them on to Gabby, send them to Trevor, send them to Andre, whoever you want to send them to. But let's get your photos in for the Hall of Fame, because a lot of you guys have not been sending in your photos for the Hall of Fame. But we need to get you in the Hall of Fame once and for all. So make sure you go ahead and do that. If you're looking to apply, join my private stock group, private wealth group, get access to all my course curriculums, access to the private Discord chat, 6 and 7 figure club, get your Steel membership cards, 1000x stocks. All that good stuff, that will be pinned comment down there. Alrighty, let's go ahead and react.
139,000 jobs created on non-farm payrolls for the month of May, a smidge higher than we were expecting. And in the rearview mirror, well, there are some revisions. We lose 95,000 over the last 2 months. All right, let's proceed now with the...
Hold your horses for just a moment. That's a big revision down. 95,000, revised down in the last, what they say there. I feel like I heard the TV all of a sudden. In the last 2 months, that's a big number. That's a big number.
Employment rate, which remains at 4.2%. If we look at the earnings from a month-over-month perspective, it comes in up 0.4. Much better than expected. We were looking for up 0.3. In the rearview mirror, at least up to this point, I don't see revisions, up 0.4. That would equal January of this year, which was the best read. To find a higher read, you're back in August of last year. Now, let's look at average hourly earnings on a year-over-year basis. Hotter than expected, 3.9. That's a couple of tenths better we're looking for. 1/10 higher than the 3.8 in the rearview mirror. That equals the first 2 months of the year, which were the highest. To find a higher number, you're going to Dece of last year when it was 4%. Average weekly hours worked, and we want to always pay close attention to this. 34.3 is wild. It's the rearview mirror. It's the windshield. It's what we arrived at this time around this month, and that means we have 3 34.3s in a row, which is building. It was 34.1 and 34.2 in Jan and Feb, respectively. Labor force participation rate, always a welcoming event. We want to bring more people in. It comes in at 62.4. This is a miss. This is the first real miss. That's a couple tenths light, both in the rearview mirror and against expectations. It equals the lightest read of the year, which was in February, to find a lower number. You're going all the way back to the last month of 2022. And finally, drum roll, please, we're going to look at what I call U6, the underemployment rate, because the actual employment rate I already gave you at 4.2 is considered the U3. So U6 comes in at 7.8. That means that we have back-to-back 7.8s. The lowest read was 7.5. That was January of this year. Interest rates are moving up. Listen, 139,000 isn't off the chart strong, but it's stronger than the market was looking for. And even though you can say that we're losing a bit of steam on job creation, what you can say is that you cannot say that it's happening quickly. And you cannot say it isn't accompanied by a mixed bag of other economic fundamentals. Some point to slower glide path, some point to better glide path. Interest rates on the week, and this is important, a 2-year closed at 390 last week, so we're basically up close to 6 basis points. A 10-year closed at 441 last week. It's basically up 2 basis points. Pre-opening equities, they like this number. Back to you.
Yeah, and obviously you can see a lot of stocks up here today very nicely. Shopify up 5+%, Palantir up 5+%, Fubo up, Google up around 3% here today. SoFi's up over 3%, Amazon, Amazing Zon's up 2+%, Cheesecake's over 57, Meta's getting close to 700 again. This was a perfect jobs number. And let me explain why this was literally as good as it could be for the situation we're in right now. This jobs number came in a little better than expected. So that takes the whole fear around like, oh, we're going into recession off the table, right? Doesn't mean recession can't come 6 months from now, 12 months from now, 18 months from now, 24 months from now, 36 months from now. But if anybody's trying to bet that, oh, we're going into recession right now, it's not showing. So that takes it off the table. But it's also perfect from the perspective of it's not some super, super strong number that would make you say, oh, the Fed should keep rates where they're at. If you're the Fed, you could look at this and you can say, well, yeah, a little better than expected, but this isn't a super strong number, and we're staying way restrictive. You look at where CPI is at, look where Fed funds rate is at, you're way restrictive right now. And so it's creating we can call it an economy that is doing okay, but it's not like it's super strong right now. It's not like this is some, banger numbers and you got, 200,000, 300,000 plus jobs coming in like you would in super strong times, right? So I think that's something very, very important to factor in. And I think it was kind of the perfect report. And I think that's why the market responded in a very positive way. And if you look now, the Nasdaq is getting, oh, baby, is it getting close to all-time highs once again? And I mean really, really close at this point in time, because we're looking at all-time highs right around here, somewhere around here roughly, 2% away or so now at this point in time from all-time highs on the Nasdaq, S&P 500 right around the same. Dan Niles.
Got some of your thoughts in advance. It does sound like you think this 20% rally from the April lows can continue, yeah?
Yeah, I think in the short term, I don't have a super strong opinion, but I think it can continue. I think we could get to new all-time record highs. But remember, the reason I believe that is I believe demand is being pulled forward. If you're a rational consumer, you're buying things like smartphones, autos, PCs, because prices are going up. You've been told that as you get towards the holiday season. And if you're a corporation, just like Apple airlifted 600 tons of iPhones before the tariffs kicked in, you're doing that as well. And you saw that in the 41% growth in imports in Q1. And remember, the U.S.
So companies do that. I'm just not convinced the average consumer is going out there and doing that. I'm sorry. I'm not convinced that Joe, who makes, $50,000 a year, doing some construction work or something like that, is looking out there and saying, oh gosh, I got to go down to Costco or the Apple store or wherever and go buy blah, blah, blah right now because I heard prices might go up. I just don't think that's happening on a large level. Not to say it's not happening at all. I'm sure there's a few consumers out there that might make a purchase because they heard tariffs might happen. But I just do not think that's happening on a mass scale at all. People buy stuff when they really, really need it or really, really want it. That's just a bottom line. So, companies are sophisticated enough that they can try to get ahead of something, buy inventory. An average consumer, I'm sorry, it's just not. Come on.
Is 25% of global GDP. So that distorts numbers all around the globe. But if you're buying a car, smartphone, PC in advance, you're not going to be buying it during the holidays. So as we approach Thanksgiving, that's when I think you have to get very worried that much like you saw earnings come in better than most expected in Q1, I think you're going to see earnings come in worse than expected in Q4 because of that pull forward.
Right.
I just 100% disagree with him. Listen, if company earnings aren't hitting, I don't think it has anything to do, come that time, I don't think it has anything to do with a pull forward of demand. It could be other factors at that particular time that make a consumer not go out there and buy something if that's the situation that happens. But it won't be because everybody's going out right now to go buy iPhones or something like that. We're just not seeing any evidence that that's even occurring.
Up cars, because we did get a couple of strong months of what we think was a pull forward in demand on auto sales, but then we just got our worst month-on-month decline in 5 years. I mean, isn't that payback already beginning?
That's the one thing and why I don't have a strong opinion right here, because I thought that would continue. And you are, to your point, Carl, you're starting to see some things get a little bit squishier. So it comes down to how much do people want to just sort of ignore that and say, hey, you know what? We got a great payroll number, though, right? And so the market's up off of that. Market seems to be trying to ignore 4.5% on the 10-year, 5% on the 30-year. And the fact that the dollar's dropped, people are like, well, ignore that because that's going to help corporate earnings, right, for companies that export. It's an interesting balancing act. And that's why, for me, with the market up 20% off of its lows after being negative entering the year, bullish, I think, on your program on April 7th, thinking there would be a short-term bounce, I'm now, again, sort of going, all right, time to raise more cash. But, I have like one short on in terms of stocks and just kind of play for a bounce to continue. But the further we get into the year, get a lot more cautious and expect another big downdraft.
So what he says there, I definitely can agree with that. In terms of if you're looking, let's say you're in a situation right now where you're light on cash, really light on cash, right? I can understand if you hold some stocks that have made some incredible runs. I can understand over the summer taking little profits here and there, right? But it really depends. It's a case-by-case basis. I talked about this on the main channel. I think it was the main channel. I talked about this a few days ago. It's a case-by-case basis. If you own a company and, the stock's gone up a lot, but it's still heavily undervalued, it doesn't make sense to take profits. But if you are in a stock where the forward P's gotten very stretched and you're looking at the stock now and you're like, man, it's risen 60%, blah, blah, whatever amount, right? But the valuation's starting to look really stretched. That is the moment. That is a moment where you can say, let me take a little bit of profits off the table, right? There's no shame in that game. But really take it on case by case. Because there's stocks I own personally right now. There's stocks that I own personally that I feel like, they're getting to very stretched valuations now at this point in time. There's other stocks I own that I'm like, they've just started their run. They got a lot further to go here. Not only for this year, but over the next several years, essentially. So break it down on a case-by-case basis, okay? Alrighty, next one up here, JP Morgan.
Some pointing out, David, the jobs number, the unrounded unemployment number has risen every month this year.
Well, that's right. This was a lot softer than the headline suggested. I mean, to me, that's one issue is that we saw over 600,000 jobs lost, according to the household survey. That's very volatile, but that was a negative signal. The other thing is cutting 95,000 out of the prior 2 months. So we've only averaged 124,000 jobs so far this year per month, over the first 5 months of the year. It's 168,000 last year. And, I'm looking at a lot of data which shows this sort of slowdown that is gradually seeping up and spreading across the economy. And I think we're missing it because we're looking at headline payroll numbers or the weirdness in terms of trade and GDP. But this economy is gradually slowing down here.
Where do we think payrolls bottom out in the second half? Are you in the sort of 80 to
at the
85 range?
You know, at the moment, I think that it'll be somewhere close to 100,000 jobs as an average going forward. But it could bounce negative,
right?
And in general, and even that is, you know, I think the unemployment rate won't go up much because we're seeing some constraint in terms of immigration. But it's just a slower economy. This is a 1.5% economy. This is not a 3% economy.
So Trump's right. Fed should be cutting.
No, I think Jay Powell is right that he can't cut right now because you've got immigration, which is pushing up wages. The wages were strong this morning. And because you don't have enough labor supply, that's going to push up wages a bit. You've also got tariffs, and that has not fed through to inflation yet, but it will. We expect to see 3% year-over-year consumption deflator by July.
But the Fed can't do anything about tariffs or immigration. That's not the kind of inflation that they are used to fighting. And if you're saying there's moderation, and they're restrictive, doesn't it just make it worse?
Well, first of all, I think they're only a little restrictive, but two wrongs don't make a right. The Fed has got a responsibility to control inflation. And remember, we've also got this fiscal package, which is stimulative early on. You're going to have a big bounce in the budget deficit in 2026, which is pure sugar. Now, if that bill turns out to be, if it doesn't pass, or more likely, if it gets toned down a little bit, then maybe
this makes me sick. Stop it. Just stop it. Listen, man, the Fed is supposed to be data dependent. They say it every time. Oh, we're data dependent. We're data dependent. We're data dependent. Looking at the data. Dude, are we looking at the data or are we trying to predict what's going to happen 100 years from now? What are we doing here? Look at the data. The data shows you inflation's dead, lower rates. That's what the data shows you. If you want to have opinions on where inflation might or might not be 3 months from now, 6 months from now, 12 months from now, 18 months from now, that's not what the Fed is supposed to be doing. That's what they caution against. Like, if they were doing that, they would have been raising interest rates throughout 2021 and not having to wait till the second quarter of 2022 like they did, right? And so, like, the data is showing them right in the face, lower rates. That's what we're showing you. But if your opinion is, well, this and this and this, people drive too fast in the neighborhood, I'm just like, put in a speed bump. Come on, people.
Fed can think then. But they really need to see, is the rest of Washington, is the other side of Washington going to tone it down in terms of causing inflation for the Fed to actually feel comfortable there? So I think they're right to wait and see.
So what underlies your 1.5% GDP prediction?
Well, because so far this century, the economy has grown at a 2% rate. And that is
Lulu, Olabulu.
From 1.5% productivity growth and 0.5% employment growth. The problem is that right now we're seeing not just unauthorized immigration, but we're seeing legal immigration fall. In April, legal immigration fell by 16% in terms of authorized visas year over year. And if you take away that extra employment, you don't have any employment growth because you don't have growth in the labor force, then you're back to 1.5% economy.
What about productivity increases as a result of AI?
We just had productivity disappoint.
Well, productivity will long-term increase because of AI, but even there you need to do capital spending and you need to do continual innovation. We need to be the leaders in AI. We need to continue to be the leaders in AI. And, I think there are, I'm in favor of deregulation in some areas to try to speed things along, but there are a lot of things that are causing businesses to hesitate to invest rather than to go full bore ahead in terms of investing right now.
Right.
I just didn't like. I wasn't feeling that one. All right, next one up here. Stacey Razcon, a semiconductor sector is showing signs of a cyclical bottom.
Nice to have you here on a very interesting day. I hope you've had a chance to actually look at Broadcom and not your Twitter feed to see the latest.
Well, we're looking at it for sure.
Yeah, I'm sure you are. I hope you have enough attention, though, on Broadcom today. What are your expectations? Did I write that intro in the appropriate manner? The stock's going straight up to the right. I mean, the hype it better live up to that.
Yeah, I think so. So, the stock's been vertical over the last month or so. I think the numbers and everything should be fine, right? I mean, the AI story still looks pretty good, and you have some of those products that are ramping into the second half. You got 40% of the revenue is like sticky, mission-critical, enterprise-focused, subscription-based software. In a world where people are worried about tariffs and things, that should be fine. And the non-AI semi business is already kind of at a cyclical low, and the expectations for growth of the street's basically modeling very little growth going forward. So it's fairly conservative there. I think the numbers should be okay. The question is just, will that be enough? To your point, the stock's up a lot. The valuations are higher. The setup's a little trickier than maybe it would have been a few weeks ago, just because of that. Sure.
Let me ask you this.
Let's pull up Avago Broadcom here and go take a peek on 1000X and see is this one attractively priced or not. Alrighty, so is this stock a deal? Well, this is a little bit of a complicated one because you're looking at a forward P pretty rich, 40, right? That's pretty richly valued. However, analysts have them experiencing even next year some really nice earnings per share growth of 25% expected here. So my thought is 25% EPS growth, but on a company that's in the semiconductor space. I mean, a 35 forward P sounds about right. Maybe even a 30. Now, if we look at revenue growth, current year expected revenue growth over 20%, next year around 16%, right? That's a little tough. I don't know. I don't know if I can really say this one's a very attractive buy, because at the end of the day, I look at it versus like an AMD, right? AMD is trading at, around a 31 forward P versus Avago 40. Now, obviously, analysts could be wrong, so these numbers can move around a little bit, but let's just assume analysts are correct in this situation, right? But the thing is, if you look at like next year's earnings per share growth, AMD, according to analysts, should have around 50% earnings per share growth versus Avago's at about 18%. And then AMD is expected to have revenue growth of about 20%, which, by the way, I think that number's low. I think they're going to blow that out of the water. I would expect revenue growth more toward the 30 number than a 20 number. And Broadcom's at about 16%. So at the end of the day, I look at this and I say, why would I want to own Avago over AMD? Both companies obviously have great technology, great chips. They both have strategies that I think are going to be very successful long term, but I can get an AMD at a far cheaper valuation with likely much better growth rates. And so if you're going to force me to go buy Avago or AMD tomorrow, buy an AMD 100%. It's not even close.
Those who may not know enough about the differences between all of these chip players, especially.
And that's what you got to do. When you go into look at companies, all these companies are fighting for your money. That's the way you got to view it. All these companies are fighting for your money. All these companies I own, all the stocks I own, right? They're all fighting for my money. They're all fighting for my money. So that's why it's very important to compare different stocks versus each other and really try to figure out, okay, this stock's a better deal than this stock, things like that. Because they all want your money. There's thousands of stocks in the market and every single one's saying, buy me, buy me.
The ones that are the most highly regarded in the AI play, what area of the market does Broadcom do better than most? What do they have that an NVIDIA doesn't have? Why would I buy Broadcom and not NVIDIA?
Yeah, you bet. So, there's sort of two competing types of silicon for AI infrastructure. One is GPUs that NVIDIA sells, and the other is custom silicon that's really for the hyperscalers. Every single hyperscaler is working on their own chips for their own workloads. Broadcom's kind of the 800-pound gorilla there. There are some other players, Marvell and Allchip and MediaTek, a few other guys in Taiwan, but Broadcom really is the big one. They've got the biggest customers. They have the best. It's a technology called SerDes. You can think about it as like a really high-speed, high-bandwidth interconnect to get data on and off the chip. They've got best in class. It's hugely important. They've got scale that others don't. And they've got long customer relationships. Google's their biggest customer. They've been working with them on this stuff for over 10 years. So that's kind of where they play. But in a world where ASICs are taking share in a pie that's actually getting bigger and bigger, they're kind of viewed as the way to play that. And it's benefited the financials, and it's clear it's also benefited the multiple.
Let's finish with just broadly speaking about the semi-trade, which is back in a big way, as you know better than most, right?
Yeah.
What's up with that? Does that have staying power?
So we'll see, right? I think it's a few things, right? So we had a postponement of the tariffs, at least for now, so that certainly helped. I think in the broad-based space, there's some signs that maybe we're reaching a cyclical bottom, maybe going into recovery. And, we'll see if that's, tariff-related pull forward or not. But, there's a lot of companies like in the analog space that are talking about recovery. And then clearly the AI trade is back on versus where things got to after Liberation Day. Even Broadcom, I think, was $140 in the beginning of April after Liberation Day as the AI trade went away. And that's back in spades, and that's driving things a lot. I think the AI trade is is real and I think can still happen, and that demand looks really strong. I think on the more broad-based demand recovery, we'll have to see as we get into the second half of the year, but near term looks pretty good. At least for now, maybe this has a little bit of legs.
All right, half hours.
Yeah, so, when it comes to, it's very important everybody understands this, because I own several of the big tech companies like Google, Meta, Amazon, right? They make their own chips as well. But they're also like NVIDIA's biggest customer, and they're also, going to be buying just ridiculous sums of AMD chips over the next few years. These companies make their own chips, but they all also have to buy from AMD and NVIDIA. And you might say, if you don't really understand this industry that well, you might say, well, if they're making their own chips, why would they even buy chips from NVIDIA or AMD, right? Which is a fair question. Here's why. The chips they're going to make custom are good for specific workloads, for specific use cases. Maybe it makes solving an issue or problem much more efficient by using their own chip for a certain blah blah blah, right? Keeps costs down. But if you want the best chips and you want the best chips for training and inference, you have no choice. You go to two companies for that. You go to NVIDIA, and now you're going to start going to AMD because MI350 is now going into production, and then MI400 next year, and that's going to knock the doors off. So if you want the best chips to move the fastest when it comes to inference and when it comes to training, you're going to go to those two companies for that. And the inference market, according to Lisa Su, is going to be exponentially bigger than actually the training market's been. But if you want specific chips for specific workloads that might make it much more cost effective to do XYZ, then you go your own chip route. So instead of, because there's not everything needs the fastest, best, most complicated chip in the world. Not everything needs a Blackwell chip from NVIDIA. Not everything's going to need an MI350 or an MI400. If you bought just nothing but AMD and NVIDIA chips for every single thing in your business, you would waste a lot of money. A ridiculous amount of money. That'd be great for AMD and NVIDIA, but it'd be a complete waste of money because not everything needs to be the fastest. There's certain things that you're trying to do. If you're Google, Meta, Amazon, right? Microsoft, all these AI companies, OpenAI, blah, blah, blah. There's certain things you want to do that you got to move as fast as possible. And you need the most advanced chips in the world. Okay, NVIDIA and AMD. But for things that are maybe a little older, a little more well-established, for some of those sorts of workloads, you can make your own chips and you use somebody like a Broadcom, for things like that, right? He mentioned Marvell as well and a few other names, but, Broadcom's the big dog there. All right, Marko Kolanovic.
Since leaving JP Morgan last summer, he was the firm's chief market strategist, co-head of global market research. He joins us here on set. Marko, it is great to see you.
Thank you. Great to be here.
So you're looking for a garden variety pullback. Does anything change based on what is unfolded this afternoon?
I mean, a little bit, because we got close to all-time highs. I believe Nasdaq was 1.5%. And then you had the sort of Tesla, you have Palantir, you have a bunch of these momentum stocks taking quite a bit of beating. So it does remind me on what happened February 19, if you remember. That was when the sort of Palantir went down and then momentum stock unraveled, So I do think that could be a catalyst for a bit of a correction because close to all-time highs, but we still have all the problems. We have a trade war. We have the sort of signs of economic slowdown. Valuations are back to highs. So, that's sort of what I'm kind of expecting, a little bit of a pullback here.
Does that negative political backdrop, has it gotten worse based on what we've seen this afternoon between President Trump and Elon Musk, or is that a sideshow?
I think it's a little bit of a sideshow. It's important for a certain company, and it can spill over. Because if you look at the Tesla is one of the biggest holding of retail investor. There were kind of a little ecosystem of stocks around it. So I think it could be a little bit of a catalyst. Although I think much bigger problems are sort of what we saw, for instance, last 3 days with ADP, with initial claims, with challenging job cuts. I think that's a real problem. And the fact that we have this trade war, which almost nothing is resolved yet, right?
Marco, a lot of folks want to focus on corporate earnings and really growth, right, as they think about the stock market and potential gains. But one thing that's really important, if you go back to, let's call it early April, when we didn't have a lot of clarity, we had a careening stock market and we had the U.S. dollar, well below, below 100. It got down to 98 or something. That's a U.S. dollar index. And we also had 10-year yields, which were much lower. Now they're much higher at 4.4%. How important is that disconnect, in your opinion, as you think about the macro situation here? Because you have a stock market that's
very close back to its prior highs, but you have the 10-year yield and you have the dollar trading near where they were when the stock market was much lower.
So there is disconnect between dollar and 10-year, right? You know, and 10-year, I think, is a problem, right? Because it sort of drives a lot of different things: real estate, commercial real estate, mortgages, all kind of things, right? Also, you need to compare equity risk premia and bond risk premia. You know, what are you earning on equities? What are you getting from bonds? You know, like, so bonds are cheaper than equities. Equities are expensive. So I do think that's a sort of a negative thing. You know, there is a bit of also this standoff between Fed and the president, right? You know, so everywhere else in the world, rates are being cut. Here, they are not. You know, eventually that has to impact negatively risky asset classes here. You know, so bonds sold off. A lot of different theories, from systematic selling to sort of this like divesting of our trade war sort of counterparts, to sort of, you know, inflation, risk, term risk premium, all kind of different things, you know, like, but that's a negative. You know, it's a negative. I do think that bonds are probably oversold at this point. Last 2 or 3 days, we are seeing a bit of a rally. I think it's more driven by a weak economic data, or signs, hints of weak economic data. So I think we could have a bit of a convergence there. So equity is a little bit lower, bonds a little bit higher, just to kind of equalize a little bit these two yields of this premium.
So a couple things. First of all, Treasury yields closed 1 year ago. The 10-year closed at 4.39. It closed today at 4.39. So, I mean, on some level, there's been much to do about nothing. I'd be the first. We've all said there's reasons why we've been concerned about bond yields. And it doesn't sound like you're terribly concerned about a big sell-off. I'm trying to qualify, you know, first of all, garden variety means also opportunity. I'm looking at a market now that also over the last few months has seen real allocation internationally. Any thoughts on that? That's the kind of work you guys did at JP Morgan. Yeah. Look where people are positioned. And again, this U.S. exceptionalism trade is something that got a little long in the tooth.
Yeah, look, I mean, I was on a Dan's podcast back in November, and I said, go buy international stocks. They're cheap relative to U.S., but that has reversed a lot. I mean, look at the sort of DAX, like that's been straight line up, like to the kind of all-time highs. You know, situation there in Europe, there is a trade war. They do depend on exports a lot, right? So I'm not so, you know, sold that now is the time to go in that trade. I think that that's sort of past, you know. With many of these international indices literally at all-time highs in the face of trade war, global slowdown, you know, valuations that are reset higher. I'm not sure that's the time now. So I would probably stay away from that. I mean, if you were in that trade, great. I probably even didn't expect it's going to go this far, right? You know, but Europe had some sort of, you know, measures to stimulate, and so there's some optimism there.
So, you know, the important thing to understand about Marco's call here is he's not calling for like end of the world crash. Oh my gosh, you know, we're going up 50%. He's talking about 5-10% correction at some point in time, right? Which, you know, could it happen this summer? Maybe, but you might have to also wait for that for the fall, right? Which was like 2018. You had to wait till the fall time to get, and obviously that ended up being more than correction. But, you know, the interesting thing about this Marco is he was highly respected around the great financial crisis time, coming out of that, and then very, very respected even in 2020. He was calling for, if I recall, he was calling for the market to go to all-time highs. You know, even during the whole Rona craziness, and it did. But from my understanding, what happened over the last few years is this man remained very, very bearish. And obviously, we know the market's been great the last few years, right? 2023, banger year for the market, 2024. And so, from my understanding, it came to a head. And, you know, once again, whether he was fired or whether he voluntarily left or was just kind of like forced out type thing, I don't know. But the moral of the story is he's out of a job right now, from my understanding, right? The JP Morgan chief market strategist named Gandalf, who left the bank last month after criticism he was too bearish, wants to know he was right all along, right? And yeah, he's out of a job right now. But the moral of the story is, you know, a 5-10% correction. Like, I just feel like, I mean, there's a 5-10% correction every year. You know what I mean? Like that's nothing crazy. Like, I don't even remember last time I didn't see a 5 or 10% correction a year. Like, it seems like every year you get one of those just randomly, if not multiple of those in a given year. Like, so I don't want us to take too much from what he's saying there, and, you know, in those sorts of things. Now, I posted this because people were wondering about Tesla stock here today. So let's go out and pull up Tesla, my Tesla. So Tesla, my Tesla is right at 300, right at 300. Look at that. And so, a few hours ago, I tweeted out this. By the way, if you don't follow me on X and you're interested in following me on X, I have it linked in the description area of this channel. So if you are interested in following me, go to the description area and you can follow me on there if you use X. But I said, if anyone's wondering what's going on with Tesla stock today, the market maker needs that baby to close around 300 for Max Payne, roughly a 5% up move, which is, look at that baby. They're doing exactly what they need to do. I guess there was a lot of people that yesterday with all the drama were buying puts left and right, and a lot of people were buying it around $300. They're either buying 300 puts or they're buying somewhere right around 300. And so in order for a lot of those puts to expire worthless, the stock needs to close right around 300 here today. So anybody that sees a move up today in Tesla and thinks like, oh, the worst is over, those sorts of things, like this baby could continue to drop easily next week or the week after. Like this is just a kind of a mechanic move. This is planned move, I guess you can say. So do kind of keep that in mind. But man, good times overall. A lot of money to be made. Hope you guys are making a lot of money out there and all that good stuff. And like I said, this summer kind of represents a good time that if some stock valuations are getting stretched, take a little profits off the table, redeploy that in better opportunities out there, hold some cash. You can still get 4% on that, and just be balanced overall. Don't get too bullish, don't get too bearish, all that good stuff. Private group members, make sure you send me in your photos, 6-figure, 7-figure club, get you in the Hall of Fame there. If you're looking to apply to join private stock group, private wealth group, get access to 1000xstocks.com. Access to exclusive weekly videos from me, all that good stuff. Pinned comment down there. Click on that, fill the form, see if we can get you access in there maybe next week. Much love and have a great day.